Welcome to the Power and Market Report. I'm Albert Liu. After a great anticipation, the Federal Reserve announced yesterday that was reaffirming its short-term interest rate target of 0%, effectively postponing any interest rate hike until later this year at the earliest. Joining me on the line to discuss the decision and its consequences is Michael Pento. Michael is the president and founder of Pento Portfolio Strategies. He's also the author of The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market, and host of the Midweek Reality Check podcast. He's on the line with me. Michael, it's such a pleasure to have you on. Welcome to the Power Market Report. How are you?
Very good, and I hope you're doing well too, Albert. Thank you for inviting me.
Thank you for being on the show. Now, after a lot of discussion, the Fed decided that they weren't going to raise, and the market seemed to take it pretty well yesterday. Today it's down. First of all, what do you think of this decision? Is this what you were expecting? And how do you see things playing out in the next few months?
Well, the rumor is that Ms. Yellen is a very dovish Federal Reserve chairwoman, and she proved it. But I think more than that, Albert, she's proven that after 7 years of 0% interest rates, she proved that asset prices have gone way out of bounds as far as their valuation. She's proven that debt levels have become too onerous for her to ever get off the zero bound range by more than a few basis points. That is what she proved to me, and the FOMC proved to me yesterday. There's just too much debt outstanding, and once they try to raise interest rates, the yield curve is going to narrow quickly and flatten because there is no really any growth globally. And in that case, asset prices would come plunging to earth and debt levels would become just completely unserviceable. So that is exactly why she's stuck at zero, and you should invest likewise, if you ask me.
Now, one article I read basically said that the Fed chickened out, and that's essentially, I think, what you're saying is after all of the talk, and I think it's ridiculous that we have a lower bound on inflation. I think that's sort of ridiculous, but she referred to that. She also referred to weakening global conditions. It does seem like they chickened out, and perhaps all of the talk was just a show leading up to this.
Well, it's not just, it used to be that the central bank had two mandates. So they had full employment and stable prices, which to me, stable means zero, correct? I mean, stable prices means no dynamic vectors off zero. So she not only said that they had a 2% target, which they've had now for several years, but she actually said this in the press conference. I haven't heard many people pick up on it. But she said that there's no ceiling, really. The 2% target is not a ceiling. So she wants to go blasting through the 2% as the Fed measures inflation, which is the core PCE inflation index. So you can better believe inflation is going to be not just 2%, it's going to be much higher than that in the future. Right now we're suffering from a lot of deflation coming out from China, or I should say disinflation, or the lack of robust inflation. But if you look at the way you measure inflation, which they don't do it, but I measure it in asset prices. If you look at home prices, if you look at college education, if you look at market valuations, you look at the massive bubble in bond prices, which means yields are into the ground, into the basement. There's a lot of inflation out there. It's just not being picked up by the Federal Reserve. It just circles around the canyons of Wall Street.
Right. And, I guess you could just substitute. Every time she says inflation is below our target, I just read asset bubbles are collapsing.
Well, that's the consequence. We've had, the global debt right now has skyrocketed since the Great Recession. We're now up to $200 trillion in global debt. That's up $60 trillion since 2007. China's debt is up 300%. So when we had this global collapse in 2008, well, what caused the global collapse? It was an over-leveraged economy, which was engendered from very low interest rates. So then China came in and they just had a huge monetary and fiscal stimulus package Their debt, as I said, is up 300%. But China is not growing. They don't have an export economy that's seamlessly growing into a consumption economy. They have 55% of their GDP was investment. And what kind of investment was it? It was government debt, government issued debt to build unproductive assets, unproductive fixed asset bubble. What's that mean? Airports without planes and bridges without cars. So this is just one example, but this is where people understand that Chinese growth, the growth of global GDP, 33% of that growth was from China. But it was all ephemeral and ersatz growth. That has collapsed. You see the emerging markets now are all in recession. And we had what I believe is one of the most overvalued, well, not what I believe, it's what if you look at the proper metrics, not forward earnings, next year earnings on the S&P 500. If you look at real metrics like the price to sales, the CAPE ratio, total market cap as a percentage of GDP, the market is just about as overvalued as it's ever been. It's either number one or number two in history. So the stock market is massively overvalued, a record amount of margin debt, mutual fund cash at record lows, 3.2% of assets. Global trade is plummeting. And the Atlanta Fed publishes a model for Q3 GDP. It's 1.5%. And then in addition to all of that I just mentioned, the chaotic instability that I just mentioned, the Fed was going to commence a rate hike cycle. That's what the belief was, and that's why I was short the market coming into this FOMC meeting. But as you started the interview, Ms. Yellen blinked. The FOMC blinked. They cannot really get far off zero. So what do you take off this? You take the fact that the monetary policies of Europe and Japan, the People's Bank of China, are not that different than the U.S. Federal Reserve. The idea going back a few weeks and months ago was that the Federal Reserve was not going to be able, were going to be able, to get very far off zero. They were going to raise interest rates in an environment of growing U.S. GDP growth. The truth of the matter is that the Federal Reserve operates under the same strictures and economic fundamentals as every other central bank. They are no different, and that means the U.S. dollar, which went from basically 80 to 100 on the DXY, is now going to come right back down. It's going to break that 94 support, and that's why I think you really should own some precious metal stocks here, which have been mercilessly beaten down to the tune of about 85 to 90% over the past few years.
Okay, now you've been on record saying that you think we're probably going to see at most 50 basis points, maybe 75 basis points. You can tell just from the Fed, the way that they're responding, and I know you like to look at dot plots and whatnot, they really don't know what they're doing. We had put up the dot plot for the viewers that they put out yesterday. They even have one person coming in negative interest rates in 2016, and then the highest, the variance is crazy, Michael. So you have one person saying we're going the opposite direction. You have another person at the high end saying, no, we're going to be almost finished at 3%. In 2016.
This is a schizophrenic Fed. It's a feckless and fickle Federal Reserve. They really don't know what they're doing. They're way over their head. Their models are all bogus. They're looking for inflation in all the wrong places. So Janet Yellen and all of the FOMC really are adherents to the Phillips curve, which says, if you can believe it or not, that people working produces inflation. So imagine they're saying to the American people, I cannot let everybody find a job. If inflation goes below, where the unemployment rate was to go below 5.1%, where it is today, is massive breakout of inflation is going to come from the ether world, and it's going to consume all of our real incomes, and we're going to just implode as a nation. I mean, how silly is that? And they've been looking for inflation for years, Albert. Remember they said once it gets below 6.5%, we're going to have this massive Phillips curve inflation outbreak, and then it went to 6, 5.5. Now it's 5.1%. Where is the wage inflation? Well, let me just say this: the Federal Reserve is a bunch of wonky academics that are studying all the wrong models. Inflation comes when the market loses faith in a currency's purchasing power through its dilution. That's it. That's what inflation, that's when you get inflation. When the market realizes that your currency is being diluted They lose faith in its purchasing power. They think future dilution is going to be massive and intractable, and prices in aggregate across the board rise. That is where inflation comes from. It does not come from production. It does not come from productivity. It doesn't come from more people producing. It doesn't come from a low employment rate. That's the huge issue here. That's the problem. So I think, like you said, we're going to get 50 to 75 basis points off of zero, and I think then she's going to have to stop. I don't think the FOMC can get much off zero before the yield curve flattens and we have a complete implosion of asset prices and debt levels become unserviceable. That's where we're headed. This is the most chaotic and destructive period in economic history on a global basis.
I think you nailed it when you said schizophrenic, Michael, because on the one hand, they don't want unemployment to get too low, lest people actually get raises. And then on the other hand, you have other areas of the government instituting higher and higher minimum wages. It just doesn't make any sense, does it? I want to get
really,
to...
No,
go ahead. Yeah.
Well, I was going to say they're so worried about this trenchant wealth gap, and I'm worried about it too. There's middle classes being eviscerated. The gap between the very rich and the poor is growing wider and wider. But the reason for that isn't that there's not minimum wage increases. The reason for that is the Federal Reserve themselves. They have caused this. They cause asset prices to go way out of whack. Well, who owns the asset prices? It's the very wealthy. Who owns 5 homes? Who has huge equity portfolios? It's not the very poor. They usually are renters that don't have any equity exposure. So that's the reason why. And they get their percentage of expenditures on those things that are most affected by inflation, which are food and energy and home and shelter. They're the ones who get hurt the most because they don't have any assets. So the Fed themselves are the perpetrators of the wealth gap.
Someone asked her that direct question, and I thought her answer was very interesting because basically, I'm paraphrasing, but she said, it looks like we're just giving money to rich people, which is essentially what they're doing. But if you look at these very fancy, convoluted, and abstract studies that have come out of academia, you see that actually we're not really affecting the wealth gap. This is totally silly. But with the time we have left, Michael, I want to go back and finish off with basically your positioning. I know that you brought a fairly large cash portion into this. Are you still holding a lot of cash in the portfolios?
We went from 50% of the portfolio to cash to 30%. I think there's going to be, and this is, you're playing a very dangerous game here, but you have to play it if you manage money. So I took about 20% of the portfolio and put it into U.S. domestic dividend-paying equities and I'm renting this position. I'm not in love with it, but I do feel that since the Fed's liftoff from zero has been delayed yet again, another time, that dividend-paying stocks are going to have a huge run here in the next few weeks and months, up until the December meeting. And then you have to look at economic data, and you look at what's going on in China and Japan and Europe. There's a good chance they're going to push further out any kind of rate increase, and that means the overnight money market, where your gamblers, hedge funds and these institutions, financial institutions, they go and they use their collateral and they borrow money and they gamble in the stock market. I think that zero cost of carry continues, and that's going to help the stock market go up. But all that means, though, Albert, is that eventually the bubble is going to get much, much bigger, and that the eventual bursting of this bubble is going to be much more devastating. And it will burst. We will have a deflationary collapse of the economy on a global basis. It's just a question of when and how long they can keep the asset bubbles, the fomenting of these bubbles afloat. Their time is limited.
Okay, and then regarding precious metals, gold, I know you like gold. I know you like the mining companies, but let's talk about the metal first. What's your outlook on gold?
Well, my outlook, as I said, I look at that support level of 94 in the DXY. I think that's going to break here in the next few days, and I think I'm pretty confident. I'm buying gold this morning as of this podcast recording. I'm increasing my gold exposure. I think mining shares have been beaten up mercilessly. I think the price of gold goes up probably to $1,400 an ounce in the next few months.
Okay, and then as far as the mining companies go, I know they've been tremendously beat up. Do you have a preference in terms of the type of mining company that you buy? You're talking about gold, obviously, but are you talking about royalty companies, streaming companies, explorers? What are you looking at?
I like gold. I like the intermediate gold producers that are cash flow positive, have very low cost of production. I think that's the safest way to play this gold rally.
Okay. Now, interesting is that in the short run, you've been short equities for a while. You've been long the dollar, but in the long run, you're obviously not a dollar bull. You literally wrote the book on the coming bond collapse. So talk about your long-term outlook and what that means for U.S. bonds.
Well, I firmly believe that fiat money in general is going to be eschewed by markets. So if I think the dollar might not necessarily collapse, let me just backtrack a second. I do believe that the U.S. dollar is losing its world's reserve currency status, but I'm not necessarily going to make a case that the U.S. dollar is going to get crushed vis-a-vis the yen or the renminbi or the euro. I don't believe that's going to be the case so much. I do believe much more that fiat currencies as a whole are going to be eschewed in favor of gold. That's my long-term call. And I do believe that U.S. treasuries are going to suffer the worst debacle in the history of economics and in the history of markets. So that's my major call. And it's just simple as this. We have $18.3 trillion in debt. Actually, the U.S. has, if you look at public and private debt, about I think it's about $53 trillion. So it's just unserviceable. I'm looking for a time very soon in our future, unfortunately, where debt service payments equal about 30% to 50% of all of our revenue. And it's going to be at that point that the U.S. dollar is going to lose ground as the world's reserve currency. And bond yields will skyrocket. That's where we're headed. Don't forget, and I'll leave you with this, bond yields, the interest that the government pays on its debt, any government, there's two reasons why their interest rates are where they are. One is inflation, and the other is a credit issue. So whereas you might say, and you might make this case, I don't, but you might make this case that deflation is the prevailing economic environment that we'll be in for many, many years. I don't buy that. But even if that were the case, you have to look at the solvency and credit conditions of Japan, Europe, China, and the United States. They are insolvent and only can service their debt if interest rates are very close to zero. When, not if, when that condition ends, that is the big debacle coming, and that's what I'm most afraid of.
My guest has been Michael Pento. He's the president and founder of Pento Portfolio Strategies. You can check out them at pentoport.com. There you're going to find information about his company. He writes a blog. He also has a podcast. And you can also check out his numerous appearances on CNBC, Fox Business, and other news channels. Michael, it's been such a pleasure having you on the show. Thank you so much. I hope we can do it again sometime soon.
Thanks for inviting me on, Albert.
And don't forget to visit powerandmarket.com for insightful interviews with the world's leading experts in economics, finance, and investing, including Jim Rogers, Rick Rule, and Michael Pento. Until next time, take care.